Welcome back, everybody, for another deep dive.
Yeah.
This time, we're going to be looking at The Most Important Thing Illuminated by Howard Marks.
Oh, yeah. Love that book.
It's a good one, right?
So good.
And we're really going to be trying to glean some wisdom about investing from this book. And
Sure.
yeah, so, Marx doesn't just give us his thoughts, which are valuable in and of themselves,
Yeah.
but he brings in a crew of experts to comment.
Oh, wow.
So we're going to be hearing from Christopher Davis. We've got Joel Greenblatt.
Oh, wow.
Seth Klarman and Paul Johnson.
Wow. What a lineup.
Yeah.
That's awesome.
So it's going to be very interesting to hear all their perspectives and how they interact with Marx's ideas.
For sure. Yeah.
So one of the things that Marx does is he, right away, starts the book off with a little story.
Oh, cool.
And this story kind of sets the stage, I think, for a lot of what he talks about in the book. And it takes us back, back in time a little bit to when he was a summer employee.
Sure.
At First National City Bank.
Uh-huh.
And, this is back in the day when the Nifty 50 was a thing.
Oh, yeah, I've heard of that.
You've heard of that?
Yeah.
So for listeners who maybe haven't, what was the Nifty 50 all about?
Well, it was this investing craze, I think, back in the 60s.
Okay.
And they were just piling into these blue chip stocks.
Right.
Like, they were convinced that these stocks were just guaranteed winners.
They thought they could do no wrong.
Yeah, exactly. And, their price to earnings ratios were super high.
Sky high.
Yeah, nobody even cared,
Oh.
because they just thought these companies were like invincible.
Oh, wow.
Yeah. And Marx actually, he saw this firsthand.
He was right there in the thick of it.
Yeah. Yeah. So it must have had a big impact on his thinking
Yeah.
about, the dangers of just blindly following the crowd.
Right. And I think that's a great kind of segue into his point about, how to build an investment philosophy.
Oh, yeah.
Yeah, it's not something you're just born with.
Right.
You got to learn. You got to gain experience.
Yeah, absolutely. Build it over time, right?
Right. And you learn from other people, too.
For sure. Learn from your mistakes. Learn from others' mistakes.
And he even mentions a few people who influenced him. He talks about Charlie Ellis and his book, The Loser's Game.
Oh, yeah. I've heard of that one.
You know that one.
Yeah.
So what's the main idea there?
Well, it's basically saying that investing is more about avoiding mistakes than making brilliant moves.
Interesting.
Yeah. Like if you can just not lose money,
right,
you're already ahead of the game.
You're doing better than most people.
Exactly.
Okay, that's interesting. Yeah. And then, of course, he mentions Nassim Taleb.
Oh, yeah. Fooled by Randomness.
Yes.
That's a classic.
A classic. That one really makes you think, right?
Yeah. It makes you question everything you thought you knew about the markets.
It does. You think about how much luck actually plays a role in investing outcomes.
You can be the smartest investor in the world.
Right.
But sometimes you just get unlucky.
Yeah, you can't control everything.
Yeah.
And one of the commentators in the book, Seth Klarman, he makes a really good point.
What's that?
He says that, keeping your eyes open helps you be ready for the unexpected.
Oh, that's good.
Right.
Yeah, you never know what's going to happen in the markets.
You don't. And Marx actually comes back to this idea later.
He does.
He does. He talks about the importance of connecting the dots.
Okay.
And spotting patterns. It's not just about crunching numbers.
Yeah, it's about seeing the bigger picture.
Right.
Understanding the historical context.
Yeah.
The forces that are driving the market.
Right. All of that stuff.
Yeah.
So, we're learning from the past. We're recognizing that luck is a factor. And we're trying to stay alert for the unexpected.
Okay.
But, that all sounds great in theory. But how do we actually apply this to our investments?
Yeah. That's the million-dollar question, right?
Right. How do we avoid getting caught up in the hype?
Yeah.
Like those Nifty 50 investors.
Right. Like, how do we not make the same mistakes?
Exactly.
Yeah.
So that's where Marx brings in this concept of second-level thinking.
Okay, I've heard of that. What is that all about?
Yeah. So most investors, I think they get stuck in this conventional thinking.
Okay.
Right? They just rely on readily available information. And they kind of follow the crowd.
Yeah.
And that leads to average results.
Right.
But if you want to outperform, you got to think differently. You got to see what others miss.
Okay, so you're not just being contrarian for the sake of it.
No.
But you're actually developing a view that's different from the consensus.
Right.
And it's accurate.
And that is accurate.
Yeah.
Okay, that sounds tricky.
It is tricky.
Yeah.
And Marx has a really good quote about this. He says, different and better. That's a pretty good description of second-level thinking.
I like that. Right. So let's say you're looking at a company that everyone thinks is a sure bet.
Okay, yeah.
A second-level thinker is going to dig deeper.
Right.
They're going to consider factors that other people might be overlooking.
Give me an example.
So, for example, they might look at the company's competitive landscape.
Okay.
They might look at, potential disruptions on the horizon.
Right, like new technology.
Exactly. New technologies, regulatory changes, things that could impact the business.
Okay, so it's about going beyond the surface.
Yes.
Challenging those assumptions.
Yes.
And developing your own independent judgment.
Yes, exactly.
Okay, I like that.
So, you're thinking 2 steps ahead. It's almost like playing chess.
Oh, yeah.
You're trying to anticipate how other investors are going to react to new information and how that's going to affect prices.
Okay, that makes sense.
Yeah. But now I'm thinking, what about this efficient market hypothesis?
Oh, yeah, that's a big one.
Right. Doesn't that suggest that it's almost impossible
to
consistently beat the market?
Right, because all the information's already priced in.
Right.
Yeah.
So Marx actually addresses that head on.
He does?
He doesn't completely dismiss
the
efficient market hypothesis.
Okay.
He acknowledges that, when you have a lot of smart people, analyzing assets prices should generally reflect the available information.
Okay.
But he makes this really important distinction.
Okay.
He says that markets can be efficient in processing information.
Okay.
But that doesn't mean they're always accurate.
Oh, interesting.
So think back to like the dot-com bubble.
Oh, yeah.
A lot of smart people were involved in that.
Right. Tons of smart people.
But that didn't stop the market from getting way ahead of itself.
Yeah, and we all know how that ended.
We all know how that ended.
Oh, well.
Yeah, and Paul Johnson actually brings up a really good example in the book. He talks about Yahoo.
Oh, yeah.
Which went from like $237 a share, down to $11 in a very short period of time.
Ouch.
So that just shows you that markets can be wrong.
Yeah, even with all that smart money involved.
Right, even with all that smart money involved.
Wow.
And so Marx argues that, true opportunities lie in recognizing these inefficiencies.
Okay.
And he points to, less followed or controversial assets as potential areas where you might find some mispricings.
Interesting.
Yeah, so it's about finding those pockets of the market where the crowd might not be thinking clearly.
Right.
Or rationally.
Yeah, where emotions are clouding their judgment.
Exactly.
Okay.
And Joel Greenblatt adds another layer to this. He says that even in well-known markets like the stock market, there can be inefficiencies.
Okay.
You might have smaller companies or companies that are going through, unique situations that are overlooked or misjudged by the majority.
So there are still opportunities out there.
There are still opportunities.
Even in a generally efficient market.
Yeah, if you do your homework.
That's good to know.
Okay, so we're talking about diligent research and analysis.
Yeah.
But this brings up another question.
What's that?
How do you assess risk in a market where so much is subjective and hidden?
Oh, that's a tough one.
It's really tough.
Yeah, it's not like we can plug emotions into a spreadsheet.
Exactly. You can't quantify everything.
Nope.
And this is where Marx's passion really shines through.
Okay.
He considers risk to be the most interesting, the most challenging, and the most essential part of investing.
Wow.
He really emphasizes that it's not just about volatility, but it's about the potential for permanent loss of capital.
Right, you can lose your shirt.
You can lose your shirt.
Yeah.
And he uses this term, improbable disaster.
Improbable disaster.
Yeah, to describe these rare but devastating events that are so hard to predict.
Right.
And even harder to quantify.
Yeah, like how do you prepare for something you don't even know is going to happen?
It's like trying to prepare for a storm that you know is coming, but you can't pinpoint when or how strong it will be.
Yeah, that's a scary thought.
It is a scary thought.
Yeah. Yeah, and that's where, like, understanding cycles can help, right?
Okay.
And kind of adopting a contrarian mindset.
Okay. Yeah, so he talks about this idea that cycles are kind of inevitable.
Yeah, you can't escape them.
But you can't predict when they'll happen.
Right, exactly. You don't know when they'll start, when they'll end.
And how bad they'll be.
Exactly.
Or good.
Yeah.
He has a good quote. He says, you can't predict, you can prepare.
Ooh, I like that.
Yeah, so how do you prepare for something like a market downturn?
Right. If you don't know when it's coming, how do you prepare?
Yeah.
Well, I think one way is by trying to understand market psychology.
Okay.
You know how investors tend to react to different situations?
Correct.
Marx uses this analogy of a pendulum.
Okay.
Swinging back and forth between extremes.
I like that.
Yeah. So, on one side, you've got euphoria, optimism, risk tolerance.
Everybody's feeling good.
Yeah. And then on the other side, you've got Depression, pessimism, risk aversion.
When everybody's running for the hills.
Exactly.
So I'm guessing most mistakes are made at those extremes.
You got it.
When people are either like super greedy.
Yeah, or super fearful.
Right.
They're not thinking clearly.
Right. And Joel Greenblatt makes a really good point about this in the book.
Yeah.
He talks about knowing your own pain tolerance.
Ooh, that's a good one.
Yeah, because if you panic and sell at the bottom.
Yeah, you lock in your losses.
You lock in your losses and you miss out on the potential rebound.
Exactly. So you got to be able to ride out those downturns.
Right. So it sounds like successful investing isn't just about intellectual understanding.
No.
But it's also about emotional resilience.
Totally. You got to be able to control your emotions and not get caught up in the herd mentality.
And this actually reminds me of another one of Marx's analogies.
Okay.
Where he compares investing to soccer.
Oh, it's...
You know, it's not like American football where you have an offense and a defense.
Right.
In soccer, the same players are on the field the whole game.
Yeah, they have to do both.
So you have to be able to shift your strategy as the market conditions change.
Yeah, just like a soccer player has to adapt to their opponent.
Exactly.
I like that analogy.
So we're talking about learning from history, thinking independently, recognizing market psychology, and being able to play both offense and defense.
Okay.
But how do we actually add value as investors?
Right. How do we actually make money?
Yeah, it's not enough to just ride the market wave.
No, you want to do better than the market.
So Marx defines adding value as achieving returns that are higher than the market, adjusted for the risk taken.
So it's not just about making money.
It's about making more money than you would if you just invested in an index fund.
Okay, that makes sense.
And he has this really interesting 2x2 matrix in the book.
Oh, yeah, I remember that.
Where he compares skillful and unskillful investors. Right. With different styles, like aggressive versus defensive.
Yeah, and the goal is to achieve asymmetry in performance.
Asymmetry in performance.
Yeah.
So what does that mean?
So basically it means doing better than the market on the upside.
Okay.
And losing less than the market on the downside.
So maximizing your gains and minimizing your losses.
Exactly.
Okay, I like that.
Yeah, so for example, let's say the market goes up 10%.
Okay.
An investor who achieves asymmetry might aim for a 15% gain.
Okay.
But they would also aim to limit their losses to maybe 5%.
Okay.
If the market drops 10%.
So you're trying to cushion the blow.
Exactly.
When the market goes down.
Yeah, you don't want to get wiped out.
And Joel Greenblatt actually brings up a really good example of this.
Yeah.
He talks about Oaktree Capital Management, which is Mark's firm.
Uh-huh.
And he mentions how they actually return capital to investors when opportunities shrink.
Oh, wow.
Rather than chasing returns in a frothy market.
So they're not afraid to sit on the sidelines.
They're not afraid to sit on the sidelines.
And wait for better opportunities.
And wait for those really good bargains.
Wow. That's discipline.
It's very disciplined.
Yeah.
So, you know, being selective, picking your spots carefully.
Yeah.
And not feeling pressured to always be in the market.
Right. You don't have to swing at every pitch.
And Marx also warns against using too much leverage.
Oh, yeah. That's a dangerous game.
Borrowing money to amplify returns.
Yeah, it can work in a bull market.
It can.
But it can really backfire when things go south.
You know, a lot of people learned that the hard way during the 2008 financial crisis.
Oh, yeah. A lot of people got burned.
So it's really important to understand the potential downsides of any investment strategy.
You got to be prepared for the worst case scenario.
Exactly. You can't just focus on the best case scenario.
Yeah, got to be realistic.
And this leads to another really important point that Marx makes.
Okay, what's that?
Having reasonable return expectations.
Oh, yeah. You can't expect to get rich quick without taking a lot of risk.
And even then, there are no guarantees.
Nope.
And he points out how low risk-free rates can affect returns across asset classes.
Okay.
So when interest rates are low, investors might demand higher returns from riskier assets.
Compensate for the extra risk.
Exactly. It's all about balancing risk and reward.
Yeah.
And he also cautions against trying to time the market.
Oh, yeah. That's almost impossible.
It's very, very difficult.
Yeah. Almost nobody can do that consistently.
Right. And Joel Greenblatt really emphasizes this point.
Okay.
He says that understanding the relationship between value and price movements is really fundamental to investing.
Okay.
And he sees Marx's insights as providing valuable context for making sense of those movements.
So it's like having a roadmap to navigate the market.
It's like having a roadmap, exactly.
I like that.
And Marx does a really good job of kind of weaving together all these different aspects, you know, economic, psychology, market cycles. right, to create this framework for understanding how markets work.
It's like a holistic approach.
It is. It's very holistic.
Yeah.
But I gotta say, it's a little overwhelming.
I know, right?
There's so much to consider.
There is.
So many potential pitfalls.
So where do we even begin?
Yeah.
Yeah, it is a lot to take in.
It is. It's kind of like drinking from a fire hose.
Totally.
But Marx does such a good job of explaining it all.
He does. He's a great writer.
Yeah, he is. And, I think it really comes down to a mindset shift.
Okay.
It's not about chasing the hottest trends or trying to outsmart the market.
Right. It's about taking a more thoughtful approach.
Right. It's about becoming a student of the game.
Yeah. Always learning, always adapting.
And always recognizing that there's more to learn.
Exactly.
Yeah.
Nobody has all the answers.
Nobody has all the answers. And Marx really stresses the importance of constantly questioning your assumptions.
Okay.
Being open to new information.
Right.
Different perspectives.
So it's not about being right all the time.
It's not about being right all the time.
It's about being willing to admit when you're wrong.
Exactly.
And changing course.
Yeah, you got to have that growth mindset.
Totally.
A willingness to evolve your thinking.
As the market changes.
The market changes as new information comes out.
Yeah. It's a never-ending journey.
Wow. This has been so insightful.
I know, right? I feel like I've learned a lot.
Me too. Marx really does a great job of synthesizing all these complex ideas.
He does.
Into a clear and actionable framework.
And that's what makes him such a great teacher.
Yeah, he doesn't just give you the answers.
Right. He teaches you how to think for yourself.
He gives you the tools you need.
Yeah, to develop your own investment philosophy.
And to navigate the markets with confidence.
I like that.
So for our listeners out there, what's the key takeaway message?
Well, I think the biggest takeaway is that investing is a journey, not a destination.
I love that.
It's about continuous learning, adaptation, self-reflection.
It's about having a process.
Yeah, having a process that you can trust.
And sticking to it.
Even when things get tough.
Right, because there's no magic formula.
No, there's no guaranteed path to riches.
It's about hard work discipline.
And a willingness to embrace uncertainty.
Because the market is always going to be uncertain.
That's for sure.
And Marx reminds us that we need to understand the range of possible outcomes.
Both positive and negative.
Both positive and negative.
Yeah.
And make informed decisions based on our own
risk tolerance.
Our
own return expectations.
Our
own time horizon. Yeah. It's all about finding what works for you.
And one of the things that really stuck with me from this deep dive is the emphasis on psychology.
Oh, yeah. That's huge.
Understanding how other investors think,
right,
but also managing our own emotions.
Totally, because our emotions can really sabotage us.
They can lead us to make bad decisions.
Especially when we're feeling greedy or fearful.
Right. We get caught up in the hype.
Yeah.
Or we panic when the market drops.
And that's when we tend to make our biggest mistakes.
So being aware of those psychological biases is really important.
It's so important, and I think that's a great point to end on.
Yeah, this has been a great discussion.
It has. It's been a real eye-opener for me.
Me too. I love revisiting this book.
Yeah, and I highly recommend it to all of our listeners.
Yeah. The Most Important Thing Illuminated by Howard Marks.
Definitely check it out, and we'll leave you with one final thought.
Okay.
Think about how you can apply these principles to your own investment journey.
That's a good one.
What's your risk tolerance?
Yeah.
What are your return expectations? Are you comfortable going against the crowd?
Ooh, that's a tough one.
When necessary.
Yeah, but sometimes it's necessary.
Sometimes it is. These are the questions that every investor should be asking themselves.
Absolutely.
So thank you for joining us on this deep dive.
Yeah, thanks for having me.
Until next time, happy investing.
Happy investing.